Hey everyone, welcome back to the channel. Before we dive into one of the most fascinating and important topics in economics, make sure you hit that subscribe button and ring the notification bell so you never miss our content. Today, we're answering questions that most people never think about, but affect every aspect of our lives. Where does money actually come from? Who controls it? And how does the entire monetary system really work? If you've ever wondered why governments can't just print unlimited money, or who decides how much money exists in the economy, this video is for you. Drop a comment below and tell me what you think you know about money creation. You might be surprised by what you learned today. Let's get started and uncover the secrets of the monetary system. Chapter 1. The Evolution of Money, from Barter to Modern Currency. To understand where money comes from today, we need to start with how money evolved throughout human history. In the earliest human societies, there was no money at all. People relied on barter, the direct exchange of goods and services. A farmer might trade wheat for a blacksmith's tools, or a hunter might exchange meat for clothing. While this system worked in small communities, it had serious limitations. The main problem with barter was the need for a double coincidence of wants. You needed to find someone who had what you wanted and wanted what you had at the exact same time. If you were a fisherman who needed shoes, you had to find a shoemaker who wanted fish right at that moment. This made trade incredibly inefficient and limited economic development. Communities began using commodity money to solve this problem. Commodity money is something with intrinsic value that everyone agrees to accept in trade. Throughout history, various societies used shells, salt, cattle, and precious metals as money. The word salary actually comes from salt because Roman soldiers were sometimes paid in salt. Cattle were so commonly used that the word capital derives from capita, meaning head of cattle. Precious metals, particularly gold and silver, became the dominant form of money across many civilizations. They had several ideal properties. They were durable, divisible, portable, recognizable, and scarce. You could break gold into smaller pieces for small transactions, carry significant value in your pocket, and everyone recognized and valued it. Governments began minting coins with standardized weights and purities, making transactions even easier. However, carrying around metal coins had its own problems, especially for large transactions or long-distance trade. Merchants traveling with heavy bags of gold were targets for thieves. This led to the development of representative money and eventually paper currency. The concept was revolutionary. Instead of carrying the actual gold, you could carry a certificate promising that gold was being held for you somewhere safe, and you could redeem the certificate for gold whenever you wanted. Chinese merchants were using paper money as early as the 7th century, but it spread slowly to the rest of the world. European banks in medieval times would issue notes representing gold deposits. If you deposited 100 gold coins with a bank, they'd give you a paper note saying you owned 100 gold coins. Then you could trade that note, and whoever held it could go to the bank and claim the gold. This was more convenient and safer than carrying the actual gold around. This system worked as long as people trusted that the bank actually had the gold and would give it to them when requested. The paper itself had no intrinsic value. It was just paper. Its value came entirely from what it represented and people's trust in the system. This was a crucial development because it separated the concept of money from any physical commodity. Money was becoming more abstract, moving from physical objects with intrinsic value to symbols representing value. The gold standard emerged as the dominant international monetary system by the 19th century. Under this system, a country's currency was directly linked to a specific amount of gold. For example, the US dollar was defined as being worth a certain weight of gold, and dollars could be exchanged for actual gold at that fixed rate. This system provided stability and limited how much money governments could create, since they could only issue currency backed by their gold reserves. However, the gold standard had limitations. It restricted governments' ability to respond to economic crises by increasing the money supply. During the Great Depression, countries that abandoned the gold standard earlier recovered faster because they could increase their money supply to stimulate their economies. The international gold standard was essentially abandoned during World War I and was finally ended completely when President Richard Nixon severed the dollar's link to gold in 1971. This brought us to our current era of fiat money. Fiat comes from Latin meaning "let it be done," essentially money by decree or government order. Fiat money has no intrinsic value and isn't backed by any physical commodity. A dollar bill is just paper, and the digital numbers in your bank account are just data. Money has value simply because the government declares it to be legal tender, and people trust and accept it as payment. This might seem like a strange system, but it's actually remarkably efficient and flexible, as we'll explore in the following chapters.
In modern economies, money creation is primarily the responsibility of central banks. These powerful institutions operate at the heart of every major economy. A central bank is a financial institution given privileged control over producing and distributing money and credit. Unlike commercial banks serving customers, central banks serve the government and the banking system itself. The first recognizable central bank was Sweden's Riksbank in 1668, but the Bank of England, founded in 1694, became the model others followed. The United States created the Federal Reserve in 1913 following the Panic of 1907. Today, major central banks include the Federal Reserve, European Central Bank, Bank of England, Bank of Japan, and People's Bank of China. When a central bank wants to increase money supply, it doesn't literally print cash and hand it out. Most money creation happens electronically. Central banks create money by purchasing assets, typically government bonds, from banks. They simply credit the seller's account with newly created digital money. Central banks can create money essentially from nothing by making entries in electronic ledgers. Central banks use several key tools. The most well-known is setting interest rates. Lower interest rates make borrowing cheaper, encouraging spending and increasing economic activity. Raising rates has the opposite effect. Reserve requirements are another tool, the percentage of deposits banks must keep as reserves rather than lending. Lower requirements mean banks can lend more, increasing money supply. After the 2008 financial crisis, central banks used quantitative easing, massive purchases of securities to inject huge amounts of money into the economy. The Federal Reserve expanded its balance sheet from less than $1 trillion to over $9 trillion at its peak. Most central banks operate with independence from their governments, preventing politicians from manipulating money supply for short-term political gain. However, this means unelected officials make decisions with enormous economic consequences. Central banks typically have mandates like promoting maximum employment and stable prices.
While central banks create the monetary base, commercial banks actually create most money in the economy through fractional reserve banking. Banks don't keep all deposited money in vaults. They keep only a fraction as reserves and lend out the rest. Here's how it works. You deposit $1,000 at Bank A. With a 10% reserve requirement, the bank keeps $100 and lends $900. A business borrows that $900 and pays a supplier who deposits it at Bank B. Bank B keeps $90 and lends $810. This continues through the banking system. Your initial $1,000 deposit can potentially lead to $10,000 of total money in the economy. This money isn't fake, it's real money people can spend. When you check your bank balance, you're looking at digital money created through this process. In most developed economies, physical cash represents less than 10% of total money supply. The vast majority exists only as digital records. Money creation works in reverse too. When people repay loans, money is destroyed. During financial crises, when many default or banks won't lend, the money supply contracts, contributing to economic depression. Banks face several constraints: reserve requirements, capital requirements, the need for willing, credit-worthy borrowers, and competitive constraints. During the 2008 crisis, despite massive reserve creation, the money multiplier fell because banks held excess reserves rather than lending, and loan demand was weak. Understanding this shows most money isn't created by governments printing currency. It's created by private banks making loans in response to borrower demand and subject to regulatory constraints. Governments influence money supply through fiscal policy, taxation, and spending decisions. When governments spend more than they collect in taxes, they issue bonds to cover the deficit. When central banks purchase government bonds, they create new money to pay for them, a process called monetizing the debt. The extent to which governments can create money through deficit spending is intensely debated. Modern monetary theory argues countries issuing their own currency can never run out of money because they can always create more. The real constraint is inflation, not finances. Traditional economists warn excessive money creation leads to hyperinflation, pointing to Zimbabwe and Venezuela as examples. The key difference between functional and destructive money creation lies in productive capacity and public trust. If government creates money to invest in infrastructure expanding production capacity, that new money has real economic activity backing it. If it simply prints money without corresponding production increases, you get too much money chasing too few goods, causing inflation. During COVID-19, governments worldwide dramatically increased spending, running unprecedented deficits. Much government debt was purchased by central banks, effectively monetizing significant portions. Surprisingly, this didn't immediately cause runaway inflation, though by 2021-2022, inflation did surge significantly. Taxation also controls money supply by removing money from circulation. If the government runs a surplus, collecting more than it spends, money is actually removed from the economy. Different governments have different freedom in money creation. The United States has unique advantages because the dollar is the world's primary reserve currency, allowing larger deficits than other countries could sustain.
Money doesn't exist in isolation within borders. Different currencies constantly interact through international trade and finance. When buying from another country, you need to exchange currencies in the foreign exchange market, the world's largest financial market with over $6 trillion traded daily. Exchange rates are determined by supply and demand. In floating systems used by most major economies, currency values fluctuate constantly. Strong economies with high interest rates attract investment, increasing currency demand. Political stability, inflation, trade balances, and speculation all affect values. Some countries use fixed or pegged systems, maintaining currency value at specific levels relative to another currency, usually the dollar. Maintaining a peg requires substantial foreign currency reserves. The International Monetary Fund serves as lender of last resort for countries facing currency crises. The World Bank provides long-term development financing. Together, they represent international governance over monetary matters, though critics say they reflect wealthy nations' interests. The U.S. dollar occupies a unique position as the primary reserve currency. Central banks worldwide hold dollars as reserves, and most international trade is priced in dollars. This exorbitant privilege allows easier, cheaper borrowing for the U.S. However, it requires maintaining confidence in the currency and financial system. Currency crises periodically disrupt the system. The Asian financial crisis, Argentine peso crisis, and others show how quickly confidence can evaporate and how devastating currency collapse can be. Some countries attempt to reduce dollar dependence. China promotes international yuan use, and others discuss alternative payment systems. Cryptocurrencies offer another potential challenge to traditional international money systems.
The nature of money is changing rapidly. Cryptocurrencies represent the first major challenge to government money monopolies since modern central banking. Bitcoin, created in 2009, introduced currency with no central authority. Bitcoins are mined computationally with a predetermined maximum of 21 million, making unlimited creation impossible. Central banks are responding by developing central bank digital currencies, CBDCs, digital versions of government money. Unlike current bank accounts, CBDCs would be direct claims on central banks, similar to physical cash. China leads with its digital yuan being tested extensively. The European Central Bank develops a digital euro, and the Fed researches a digital dollar. CBDCs could fundamentally change money creation and distribution. Instead of working through commercial banks, central banks could potentially give money directly to citizens, making monetary policy more direct and effective. However, CBDCs raise serious privacy and government control concerns. Unlike physical cash providing anonymity, digital currencies create detailed transaction records. Blockchain technology underlying cryptocurrencies has applications beyond currency. Some envision decentralized finance platforms where people lend directly through smart contracts, removing intermediaries. Commercial banks aren't standing idle. They're investing in technology, offering cryptocurrency services and lobbying for favorable regulations. The future monetary system might look very different. Money creation could become more decentralized, with larger cryptocurrency roles, or more centralized with CBDCs giving unprecedented control. We might see hybrid systems where government digital currencies, private cryptocurrencies, and traditional bank money all coexist. Questions about who should control money are becoming more pressing. Should money creation remain a government function? Should it be decentralized across cryptocurrencies? Should tech companies create their own currencies? These are fundamental political debates about power, freedom, and government's role. Financial inclusion is another crucial consideration. Approximately 1.7 billion adults globally lack bank accounts, but many have mobile phones. Digital currencies could potentially provide financial services to these unbanked populations for the first time. We've explored how money evolved from physical commodities to digital entries, how central banks create the monetary base while commercial banks multiply it through lending, how governments influence money through fiscal policy, how currencies interact globally, and how money's nature is being reimagined through digital innovation. Money creation is complex. It's not just governments, central banks, or commercial banks alone. It's a complex interaction of all these players, plus international institutions, market forces, and technological innovation. Control over money is similarly distributed and contested among these various actors. Understanding where money comes from and who controls it is essential for financial literacy. It helps you understand why interest rates matter, what inflation means, why exchange rates fluctuate, and how economic policy works. It reveals that money isn't mysterious, but a human-created system that can be changed based on society's needs. As we move forward, the monetary system will continue evolving. Decisions about how money should be created, who should control it, and what principles should govern it will shape our economic future. Whether digital currencies democratize finance or enable surveillance, whether cryptocurrencies become mainstream or remain niche, whether the dollar maintains global dominance, these outcomes depend on decisions being made right now. Now, I want to hear from you. What surprised you most about how money is created? Do you think central banks have too much power, or is their independence important? Are you excited or concerned about digital currencies? What do you think money will look like in 20 years? Share your thoughts in the comments below. If you found this valuable, please give this video a thumbs up and share it with anyone who's ever wondered how money really works. Make sure you're subscribed with notifications on so you never miss our explorations of economics and finance. Thank you so much for watching, and I'll see you in the next video.